Hello, fellow investors. Welcome back to Investing Tutorial, your trusted source for navigating the complexities of the financial world. Today, we're tackling a hot topic that has intrigued and puzzled many. Why does Warren Buffett, the Oracle of Omaha, consider real estate investment a less than stellar choice? For his opinions on contemporary digital assets like Bitcoin and NFTs, Warren Buffett receives a lot of criticism. He has referred to Bitcoin as a worthless asset that produces nothing, and he has stated that he would not purchase all of the cryptocurrency for $25, despite the fact that buyers were prepared to spend up to $40,000 for each coin, and that its entire market value exceeded $1 trillion. Buffett believes it to be absurd. In fact, this is not the first time he has spoken such strong criticism of a newly emerging technology. During the dot-com bubble, for example, he expressed similar opinions about internet enterprises. Bill Gates, a close friend, made several attempts to persuade him to invest in such firms like Microsoft, but he consistently responded with the same response. He has squandered numerous excellent chances, as seen by the rise in at least a few thousand% in the stocks of Amazon, Netflix, and Tesla. When Tesla went public, a $1,000 investment would be worth around $225,000 now. For $5,000, you could have become a millionaire. A few $1 million invested in these businesses would have a minimum value of hundreds of millions of dollars. In spite of his numerous wasted opportunities, he has a net worth of over $100 billion. In fact, during the last recession in 2008, he was proclaimed the richest person in the world, surpassing even Bill Gates. This was during a period when the economy was in decline and the stock market was plunging. In addition to cryptocurrency technology and natural resources, Warren Buffett has consistently shied away from the real estate sector. Unbelievably, Warren Buffett has never made real estate investments. The only property he has ever owned is the $31,500 Omaha, Nebraska home he acquired in 1958. The equivalent of around $290,000 in 2023, where he has resided ever since. Consequently, it begs the question of why, despite real estate being the safest investment option available, the most successful investor in history never makes real estate investments. Does Warren Buffett have knowledge that the rest of us lack? Give this video a thumbs up and let's find out. You can comment on Warren Buffett's investing style before we address all of these topics and many more. However, that won't alter the fact that he has outperformed the S&P 500 by 84% over the last 20 years. He has a lengthy history in the stock market and has made numerous profitable investments. When someone asked him about purchasing a home, he advised doing so if they intended to remain in one location for an extended period of time. He even referred to a 30-year mortgage as the nicest thing ever. But why doesn't he invest in real estate if he believes it to be such a wise choice, particularly in light of the collapse of the housing market? For the first of 6 reasons, real estate differs from the stock market in that it requires full-time management and goes beyond simply owning a property. Must maintain it and pay your mortgage even if you are unable to locate tenants. Additionally, things break, and finding renters during hard circumstances might be difficult for a while. To be clear, Warren Buffett avoided the real estate market because he recognized it would demand a lot of his time and that he preferred to concentrate on making excellent investments. The second reason Buffett stays away from real estate is that it's difficult to find good deals in the market. To make a great investment, you have to find a great business that's inaccurately priced or priced lower than it actually costs. He did invest in real estate, but mostly through something called real estate investment trusts, which are similar to stocks. He owns a large part of a company called Store Capital Corp., which is a real estate investment trust. For whatever reason, the company may have invented a technology that will yield enormous revenues, or it may have the ideal foundation for easy scaling. The stock market gets flooded with mispriced equities once it is generated in large quantities, particularly during a crisis when people panic and start selling. This sell-off drives prices down and interest rate spikes deter investors. For instance, and they begin selling off their stocks in large quantities to the point where, from April to June, Apple's price declined by about 25%. However, did Apple also lose a quarter of its workforce in a short period of time? No. Did its sales decline by 25% in a short period of time? It's far simpler to locate a wonderful deal in the stock market than in real estate because, first of all, values in real estate don't change as quickly, and the panic drove the market down, hurting even outstanding enterprises. Indeed, we don't have a real estate exchange like we do for stocks, where you can browse through multiple properties from the comfort of your office. Unlike real estate companies, which must go through a rigorous approval process before being able to list their stocks in the stock market, real estate crashes happen occasionally, but they usually happen once every 1 to 2 decades. If there is a great deal on the market, a real estate agent in the area will probably close the deal for himself before everyone else finds out. Additionally, they must release their financial accounts on a quarterly basis, which gives Buffett an advantage over competitors when spotting good bargains. Real estate mostly just provides you with a place to live. It doesn't generate much revenue. Though few individuals can afford it, some exclusive establishments may charge $10,000 per night. Yet, a business can continue to expand and generate revenue indefinitely. In 2018, Buffett paid $36 billion to purchase 5% of Apple. As Apple's value increased to $3 trillion in a matter of years, his stake rose to $160 billion. Additionally, he received a yearly dividend of almost $775 million from Apple. Even though it's not his greatest bargain, you can't do that with real estate. Buffett invested $25 million in See's Candies Company back in 1972. Since then, the company has returned $1.35 billion to Buffett's Berkshire Hathaway, even after the $32 million has been counted. Given what Berkshire invested in the company, the return on that investment is still absurdly high. The third argument is that, very simply, there is more money in the stock market than in real estate. The U.S. real estate market is valued at approximately $3.7 trillion, whereas the stock market is valued at approximately $93 trillion. Since the housing market is not as large as the stock market, none of the top 10 richest persons in the world are real estate investors. Instead, every single one of them has created a business or produced something. Actually, the wealthiest real estate investor is 91-year-old Lee Shao-Ki, a Hong Kong-based real estate developer with a $28.6 billion net worth, making him the 29th richest person in the world. Despite all the prospects in the stock market, Donald Bren is the richest real estate developer in the United States, with a net worth of just $17 billion. Buffett wants to make the most out of his time and abilities. If he can make over $100 billion from stock market investments, why would he invest in real estate? His success was initially attributed to his steadfast adherence to his core values and strategies. He never buys new assets just because they're popular. Perhaps that's the most significant thing we can take away from him. Purchasing a home is a wise move if you intend to live there for a long time, but investing in real estate is a business. If the answer is no, you should pursue another line of work. There's no sense in committing yourself to a venture in which you lack the necessary skills or enthusiasm. The fourth reason. In contrast to other asset classes such as stocks, real estate lacks liquidity, which is the ability to quickly convert an investment into cash. With stocks, you can sell your shares almost instantly on the stock market and often have the cash in hand the same day. This is the fourth reason Warren Buffett avoids real estate investing. However, real estate is a different matter. For someone like Buffett, who values being able to move quickly and take advantage of market opportunities, selling a property can take months or even years, especially if the market conditions are unfavorable. In the fast-paced world of investing, having assets that can be easily converted to cash gives an investor flexibility and agility. For Buffett, who must be able to act quickly in response to market fluctuations and frequently makes big investments, one major disadvantage of real estate is its delayed liquidity. His investment strategy is heavily reliant on his desire for liquidity, which enables him to remain flexible and adaptable in the ever-changing financial environment. Another important factor contributing to Warren Buffett's avoidance of real estate investments is his ability to manipulate money, or more formally, his flexibility in capital allocation. Consider it this way. Buffett enjoys the flexibility to quickly reallocate his wealth, much like a chess player rearranging pieces on a board. He must have the flexibility to seize an opportunity when it presents itself, or to back out if things aren't going well. Investing in real estate is like trying to move money around in a vice-like state. It takes time to acquire or sell a property. It's a drawn-out procedure that involves numerous paperwork exchanges, discussions, and waiting for someone like Buffett to act quickly after spotting a fantastic investment opportunity. In the stock market, a slow pace is often discouraged. Buffett, on the other hand, is considerably faster at managing his money. He can buy or sell stocks in a heartbeat and change his holdings around. When the market behaves like a roller coaster, it is crucial to adjust this speed, as per his discretion, in order to maximize market ups and downs. Swiftness of movement is a great advantage. Warren Buffett refrains from investing in real estate for still another reason. He believes in staying within his area of expertise. Buffett's investment strategy revolves around this idea, which emphasizes the value of making investments in fields in which one has extensive knowledge and experience. Buffett's success can be attributed to his strong belief in investing in what he knows and understands. Buffett possesses a deep understanding of businesses and how they might perform in the stock market. He has honed his abilities for decades to analyze market trends, economic indicators, and corporate financials in order to make well-informed decisions. This is not a real estate-related grasp of business and market dynamics that D has acquired. A distinct set of abilities and knowledge are needed for real estate investing, such as familiarity with the local real estate market, property management, and the complexities of financing and development. This is not the same as examining company balance sheets or forecasting market trends. Buffett has frequently discussed the risks associated with venturing outside of one's area of expertise, as doing so can result in poor decisions and elevated danger. Because he stays inside his area of expertise, Buffett is able to make better judgments, minimize risk, and enhance his investment methods. It displays a methodical approach to investing in which information and comprehension serve as the cornerstones of judgment. There you have it, savvy investors. Warren Buffett's perspective on real estate investments offers a unique insight into the mind of one of the greatest investors of our time. As we delve deeper into his reasoning, remember that Investing Tutorial is here to provide you with diverse perspectives to help you make informed financial decisions. Don't forget to hit that like button, subscribe for more investment wisdom, and join us as we unravel the secrets of the financial world together.